Right. Well, hello. How are you? Thank you very much. Today we are going to introduce our first webinaries. Can all hear me? Please put a finger in the chat if everyone can hear me, or at least can tell me if they can hear me. Excellent. Thank you very much. So we are starting our first webinar of SkyView Analytics. I'm going to introduce myself and then we are going to start into the platform and we are going to explain and give some educations in terms of options and stocks. My name is Sebastián Musso. I am economist. I'm also studying for the CFA certificate. I have worked as an actuarial and I am also a software developer, more focused into the backend and also algorithms. The webinar of today is divided into 3 sections. The first section is basically explaining what is IB, that is like one of the most questionables and one of the most unknown parts into the option and in the financial sector questions and area, how it's calculated, etc., etc. So we are going to go deep into that and we are going to explain it. The second part of the talk is going to be more into the platforms to explain what SkyView Analytics can offer to you, how you can improve your trades with us, and how you can basically scan the whole market in a couple of seconds. We are just one of the only companies that can offer this service to pro and non-pro traders. Basically, the pro and non-pro is divided because of regulatory of OPRA, which is the SEC for the stock, but in the United States. And finally, we are going to talk a little bit about more into the market and explain which strategies you can perform in this volatile bearish market. Well, basically, those are the 3 areas. So I'm going now to share my screen that I think that I am doing. So that's okay. So, of course, before we begin with the webinar, we also have a weekly report that you can subscribe where we basically give information about stocks, 3 stocks and how the market performed in the last week. These 3 stocks, basically we give you information about fundamental data, but also a lot of option data in terms of how you can perform a strategy into the option market with this stock and with these underlines. The last week we explained, okay, Baba, which is a Chinese company with stocks in the United States, which has performed not very well because of different subjects in terms of internally with the government of China, which basically now they want basically Chinese company to return to China rather than to stay in America. So that's been a big issue for American investors in terms of accepting to invest there or, to retire into the Chinese stocks, which 2-3 years ago were extremely popular. Alibaba, Tencent, Billy, and other companies. Then we also explained for this week ExxonMobil and CBX, Chevron, which basically are companies into the energy sector, oil companies that perform extremely bad. But these years we have to applaud them because are the only ones who have had a positive return in the portfolio. So despite of the fact last week was horrible, they have performed really well, like you can see here in the case of ExxonMobil, with an increase of 40% year to date. Amazing return compared to the Standard & Poor's, which was 25% negative, or sorry, Standard & Poor's was more 18% negative, and Nasdaq was 25% negative. So amazing returns for all companies and for the people who projected and of course invested in these companies. Now, returning to the webinar, stated before, this is going to be divided into 3 sections. The first section, which is extremely important, is talking about, okay, volatility and how we measure volatility and what is volatility, how this volatility is different from stock volatility, how options volatility is different from stock volatility. So basically, IV, or implied volatility, is a component into the structure of the price of the option, is the part of the option value that you cannot see. What do I mean with this? Well, for an option to have a price, it has 5 variables. The first variable is basically the strike price that you choose. Then the time period that the contract will have, the length of the contract. The shorter the contract, the less value will have. The longer the contract, the more value will have. Then basically is the price of the underlying. And then is the interest rate. The interest rate now is having a little more of basically is getting more importance, because as we know, the Fed is increasing interest rates. As it's increasing interest rate, this is impacting in the options market, and we are going to have a whole webinar for that, so don't lose the next webinar for that. But the implied volatility is like something, is the output number 5, where basically is impossible to see. So you can see the interest rate, you can know that value, you can know the strike value, you can know the length of the contract, and you can know the price of the underlying. But implied volatility is, I call it, and this is personally, I call it like dark matter. What is dark matter? Well, in the universe, you can see stars, you can see galaxies, but we know that there is dark matter, but we cannot explain it 100%. Implied volatility is the result when you make the mathematics of the current option price and these 5 inputs, where 4th input, I'm going to repeat it again, which is the strike price, the current price, the interest rate, and when the contract is expiring. And as a result, we can see the implied volatility. The implied volatility is something that each strike price of the contract has, is unique for each contract, and it's something that is constantly changing. It's not like a constant value, it's 100% constantly changing. And basically, you can calculate the expected movement of a stock or an ETF, depending of this implied volatility of the option contracts. Now, a question that I am really frequently asked is, okay, which option contract do you use? Basically, the option contract that you have to use is the one that is at the money. At the money, as it says here, I'm going to read the average implied volatility of at the money contracts for the next 2 regular periods is the way that basically the market says, okay, this is like a correct way to calculate it. Okay, that's basically the way that people say, okay, that's the implied volatility of that underlying asset that is representative for it. So what do you do with that value? Like, okay, we understand now how the implied volatility is calculated. We understand which one we should take from all the option chain. Now, how we calculate the expected move, that is actually why volatility is used for. Volatility is used for basically to know an underlying asset, how much is going to move into the market. Okay, and this calculation, sorry, It's basically done like this in this basic example that you can perfectly go into our platform, and we are going to discuss it now in our platform, or you can perfectly use it in the Excel. That is the IV divided by square root of 256 trading dates. That's extremely important. It's not a year calendar. It's basically the trading days that there are in 1 year. That is actually 256.3, but basically it's 256. And there you have the expected volatility for 1 day. Okay. Having said that, expected volatility, basically what used is one standard deviation. One standard deviation in statistic means that there is about a 68.8 or 69% probability that the underlying price is going to end between these two prices. Okay. So of course, when the market is extremely volatile, this is still very representative. Why? Because IV is going to increase. And now we are going to see some examples. So if IV is going to increase, the expected price movement is going to move. It is going to be bigger. When the implied volatility goes down, what happens? The opposite. The movement is going to be shorter or less in terms of price. So here we have some example of Apple's stock price at 154. This was 2 weeks ago. And we calculated with an IV of 34.71. So you did set 34.71 divided by square root of 256. And basically the daily expected move was going to be 2.17%. So you calculate 2.17% up, and you calculate 2.17% down. And basically there you have the max price for that day based on the implied volatility of at the money contracts of Apple that day. The most important thing when you trade options is to decide the length of the contracts. That's one of the most important things, like how long I'm going to go, how short I'm going to go in terms of length. So basically, if you can use the same, you can do the same calculation instead of 1 day for 22 business days. Okay. And the result would have been that the expected move was going to be at 10%, 10.18%. And this would have created a situation where Apple stock would have moved between $170 and $138. So basically, you have put here 138 and 170. Here in SkyView Analytics, we provide you the implied volatility of Apple in 5 minutes delay data, which is basically extremely representative of actually what's happening into the market. That's very important to say. Then implied volatility is just one of the instruments. There are other instruments where you have to take into consideration, which is IV percentile and IV ranking. So IV, as I explained before, is a measure of how volatile is the option contracts. But the most important thing is to compare to peers, to companies in the same sector, same industry, or same group, but also compared historically. That's how we use implied volatility percentile and implied volatility ranking. Implied volatility percentile, here there are also lots of discussions and many discussions that people say, okay, which one should I use? IV ranking or IV percentile? Well, you should use both, but from our point of view here in SkyView Analytics and in our models, we use more implied volatility percentile. Now I'm going to give you the reason. IV ranking, let's start with IV ranking, basically takes the lower point, the max point, and it tells you, okay, from 0 to 100, in which position you are. But those are points in the chart that might not be very repetitive. You know what I mean? It can be just a very high point or a very low point, and basically that's it. So if you are between 0 and 100 and you have a 50 implied volatility, you are going to be in the middle of the chart. IV percentile, instead, it takes into consideration how many times, like basically here it expresses it perfectly, the percentage of days in a selected period that the IV has been lower than the current value. So I'm going to repeat it again. It's the percentage of days in a selected period that the current IV, the IV that we have just calculated with Apple, has been lower than the current value. So we will have a value of 70%, 80%, 90%. We can state that 90% of the days, the IV has been lower than the current value. It's much more representative than just taking two absolute values. So if you're going to do a strategy, I would pay much more attention to the IV percentile rather than the IV ranking. Then, of course, what you have are the IV change, IV percentile change, IV ranking change, etc., which are daily measures and changes, which are quite important. And that's why I have here the weekly report. So we can see how we can, for CBX, the IV was between 35 and 20 and 34. And on Friday, it jumped to almost 43. This jump was magnificent, was like extremely big. And for people who sold basically and received credits, as it says here. So basically, people who decided to receive a credit as a start or as a beginning of the entering into the market, into contracts, if they did that, well, that would have been like a very good trade at the beginning, to say so, instead of entering into a market on the 22nd of September, 21st of September, etc., etc., etc. So I don't know if there is any questions so far, or I can keep going. I am basically, I am looking at the chat, so if no questions, I can keep going. Excellent. So that's basically the explanation. First of all, just to be sure, can everyone hear me? Gonzalo, you can tell me if you can hear me, or Eugenia or Lucia. All good, perfect. Thank you very much. You know, when doing webinar, it's very important to be sure that the communication is clear. So thank you, Rodrigo. So now let's jump basically to the other part of the webinar. So that's how to interpret IV. IV is one of the 5 inputs for the option pricing. It's extremely important to have it into consideration. The higher the volatility, the higher the expected daily move. There are some companies which, thank you very much. There are some companies which have less movement, and now in the second part of the webinar, we are going to jump into the platform, and I'm going to show a little more what do we have here and how do we do things in SkyView Analytics. So basically, this is the home. This is the area where you have information just about the market, the performance of stocks and how they are doing. You can perfectly press in one of these tickers, and you can visualize some information which is basically providing you information of SkyView Analytics forecast data, that this is based on volatility. We are going to do 100% a webinar over this, and also you have fundamental data. Let's take Costco because basically it was here in the top. Year to date, it has been an increase of 6.29%. The daily range has been between these two values. And here we provide you some fundamental data, which is really important to compare to peers. That's one of the most important things, and that you have to do is, okay, you have this fundamental data, but how do I know that this information is trustable, is good or bad? Well, basically you have to compare it with peers. You have to compare it with historical values that we are going to show now that. And also you can see the income statement for this company as an example. We have seen that the total revenue, that basically are sales, if you compare 2021 with the quarter number 3 of 2022, it has increased almost at 6%, which is quite good, and this explains, you know, this increase of 6.3%. You can divide this into quarters, but this is one of my favorite charts. What you can see, well, Costco is like a big supermarket, it's like a big mall. It has a lot of revenue, but little net income. So these companies are really consumer defensive. You see this into Walmart, into Costco as the top companies, where the market scares, the money goes and floats into these companies. So we can see that today the volatility for many of the stock has increased. This can be divided into stocks or ETF. Mega cap basically means the size of the market capitalization or the money that the ETF has. You can see that if we return to stocks, market capitalization, this is going just to show the company that has a market capitalization above $198 billion. If I put here 50 companies, we can see all the 50 companies, and as you can see, Coca-Cola is and Johnson & Johnson, which are consumer defensive. We can see this here. Sorry, because of the webinar, this goes a little slower than usual, but this is again because of the webinar. This is healthcare, but if we go to Coca-Cola, is going to be consumer defensive. And of course, for stocks like consumer cyclical, which are companies that depends on the GDP growth of the American economy, etc. This is more. These tend to be more volatile when markets are into red areas, when markets are going down. So now, and this is one of the most important tools that we have, how we can scan the options market in real time. Okay, this is extremely important, talking into scanning the market in real time. Why? Because the options change and the options value, as they have a lot of strike prices, deciding in which one you have to invest is extremely difficult. Most important is to make it comparable. And why it should be in real time? Well, if you are using Excel and if you want to go from one company and jump to another company, time pass through the underlying stock price moves, and then this is going 100% to affect the option price. So this is the main reason why you should scan the market into real time. If you don't do it in real time, you are not going to have good results. You are going to have failures. You are basically not going to succeed into finding which one is the one that has greater probability of profit or greater return over risk. So here we have just scanned the market. We can see that today is a pretty red day. And you can see how basically this constantly change. You can see the year price change, different columns with sector, with IV. This is very important. This is very important. Now I'm going to choose strategy, etc. But here you can have the information of IV. I'm going to pause a little bit the scan of the market. We are going to change it from 10 seconds to 1 minute or 5 minutes. So we can pay a little more attention to what we are looking at. First of all, we are looking at ETF. This is the underlying type. Here, if you have the icon, basically means that this is information for you to read of how we do things, what this means. You also have here an area of walkthrough, which is explaining exactly how basically the market scan works. But besides that, we are going to pay a little more attention to, okay, the underlying type. What are we scanning? In this moment, we are looking at the ETF, large cap. Large cap, we can see here that are companies or ETFs, in this case, between 10 billion to 198 billions. Sector equity, you have different sectors. Stock earnings is extremely important to have this into consideration for stocks, not for ETFs. That's why we make it unavailable for you to basically change it. Option volume, this is not that much important. Contract expiration, this is very important. This is basically, okay, where in the future I am looking at. That's extremely important. Where in the future I want to contracts into 2 days, 5 days, 1 month. Here you can have it. Into December, maybe 95 days, or the coming year. We have contracts to analyze in January 17 in 844 years, which is quite amazing. The optimization criteria that you can change into, this depends over the strategy, but you can basically, you have 3 optimization criteria, but this is how the ranking is going to be created. Stop price range, we can change it here. Maybe we are looking for ETF in this case, which are less than, let's say, $70 or $80. So we can, oh, sorry, I forgot to change this one. So this is going to be a little mess. Each time you have, when you refresh or when you apply new filters, you have to put 10 seconds. So the scan doesn't have to start over. But as you can see, we scan the market in less than 10 seconds. Current underlying price, you can see that this is less than $80. Implied volatility is also very important. We are going to play with this right now. Let's say that you want extremely low volatility, let's say about 30, so these 2 can disappear. Let's do that right now. Apply. So again, what we are doing is grabbing all this information and all these filters and applying it into a market. And as you can see, the IV here now is less than 30. Okay, so now you're seeing ETF that today are very red and over the year has been quite red. XLU hasn't been that bad, but yes, basically today is a red day for the market. Now, the level of moneyness. The level of moneyness, it means basically which type of contracts you are looking for. You're looking for contracts that are at the money, in the money, or out of the money. That depends if they are puts or calls, okay? So puts that basically the value are less than the current market are called out of the money. Let's say that you are looking at contract, as an example, Apple now it's 150 and you want to protect from Apple fall and you're looking at a price of an option price of a put for doing that of 145, well, that's out of the money. The same for calls. If you want to sell a call that is above the current strike price, is out of the money. Usually traders tend to use more out of the money contracts than in the money contracts. You can use standard deviation or you can use as a percentage. We are going to explain this into a next video because this has to be extremely well explained. And it is really important to define the difference between standard deviation or percentage, where basically we offer both. to scan the market. We can change this. We can use, as you can see, long put out of the money, let's say 0.3 standard deviation, and will appear out of the money. Let's see if we can find any type of contracts, and we are now going to enter and we are going to focus into one of these contracts. So as you know, when you're buying a put, the probability is quite low. Why? Because you are starting with a debit, not with a credit. So here we have. Yes, Nicolas, all the data is displayed in real time, as you can see, and as you have seen that we have changed all the values. So this can basically show you that everything is done in real time, and that's why this platform is quite powerful compared to the delayed data that others offer. So you can see here that there is a put. Now going into this strategy, basically this is telling you that this is the ticker. Let's do it from here. I'm going to explain it. Let's do a long call. Let's go into stocks that people are more worried into stocks rather than ETF. Let's scan all the markets. Let's use at the money long calls with optimization criteria of probability of profit going over the 30th of September. Instead of going to the 30th of September, let's go on over the 21st of October. Let's try to find an implied volatility a little higher, because stocks, as you probably know or don't know, implied volatility tends to be much bigger. Why? Because ETF basically are compound of stocks. So when you have a portfolio of stocks, the volatility of the portfolio goes down. Why? Because you have stocks with higher volatility and others with lower volatility. Okay, so basically they tend to, once go higher, other lowers, they go to the middle. And let's go to stock price range, and this, as we are going to scan the mega cap, usually mega cap tend to be the price a little more expensive. So after applying these all filters, again, we should have in less than 15 seconds, we are going to have a ranking, as you can see. And basically CVX that we were talking today, pretty amazing. What is this telling us? Okay, if you are, and we can check this into SkyView trend. If you are bullish into this stock, now we are going to stop this. If you are bullish into this stock and you want to buy a call contract, it's going to cost you, the strike price is going to be 140, and it's going to cost you $7.3. Okay, this is what you have to pay. Now CVX, we have already seen the ticket. Now let's go to the strategy detail. Strategy detail, again, is a extremely important tool that you have to pay attention. It explains all the Greeks that we are going to do 100% a webinar over the Greeks and using the platform and how to read the Greeks. But basically what this is telling you, this P&L is telling you, okay, if you go 140 and the stocks at the end, the blue line is at the end of the contract. So basically it's expiring over the 21st of October. That means that you are going to lose $735 per contract. How this 735 is calculated? Well, is this 0.3, this 7.3 multiplied by 100. Okay. Just for you to know, we tend to use for the P&L calculation, we tend to use the max loss. That the max loss is a little different from this value, from the debit credit, because for the max loss, we don't use the middle point, we use the ask, which makes quite sense, because sometimes it is sometimes when you go into a market and when you want to buy that contract, you cannot do it at the mid price. So, well, basically you are at the beginning, when the contract expires, if this ends below, if this ends at 140, you are going to lose $735. But if the break-even point that this is telling you is going to be between 147 and 148, actually the break-even, you have the value here. If the stock ends above this value, you are going to make a profit. Okay, so we are going to save this strategy. You save this strategy. We are going to create a portfolio. We are going to call it webinar 1. That portfolio has been created. We are going to put that strategy that is going to save the name, save the probability of profit. You have the break-even price, the expiration date. Return risk is impossible to calculate for this strategy. Why? Because the return can be infinite, and we are going to save it. This is extremely important. Here you can see that this is saved in webinar 1. And then when we go to track portfolio, that we are going to do again another webinar to see how we read this information is already been created here when you are going to see all the inputs into here. So again, I don't know if there is any type of question in regards to the market scan, or we can follow up with the last part of the webinar. If it is everything good, I'm going just to jump into the last part of the webinar. Okay, well, so now we are going to hear a question. Thank you very much, Lucia. I much appreciate that everything is clear. So, and also Rodrigo. So what's the current market situation? Well, basically that's one of the tools that we have. We are going to explain other tools in our webinars. Well, the current market situation is that now you have to, if you are bullish into a market and you are thinking, okay, the market has fallen a lot, and you are thinking, okay, what's going to be the perspective into the future, you have to decide basically if choosing a strategy that you have to pay a debit or create or have a credit at the beginning of the contract. So if we go here into choose strategy, you have long call, or you could go to a short put. As you can see, that and basically we can you can see a video here, but you can read all this information that I'm going to express now. You can see that the chart is basically the opposite. In a long call, you start negative. In a P&L, profit and loss, negative, 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 negative. When you reach the strike price, it starts going up, up, up as the market goes up. For the short put, is you start with a credit, and if the market goes up, basically you just receive this credit from moment zero, which is quite great. And if the market goes down, you start losing. In the long call, if the market goes down, you care less, basically. Why? Because you have already, you know how much you lost at the beginning. When to use the long call? Well, basically when you are bullish or very bullish, break even is the strike price by the net debit paid. Max loss is the net debit paid. As I said, is what you paid at the beginning. Max win, theoretically infinite, but we know that, of course, it's not going to jump to $1 billion each stock. The sweet spot is when the underlying price skyrockets. Volatility is a friend. Volatility is a friend, and I want to repeat this. When volatility increases, basically, as you have paid for a stock, and the ratio of the stock price increases, and the probability of the stock price has a bigger movement, This means that the price, as we explained at the beginning with giving some information of implied volatility, this is going to be great for this position. Time decay, basically the time when passes through when the contract you start and it's made and starts making smaller, it's an enemy. Why? Well, basically you have less time for this to happen, this jump to happen. Okay. The short put. With this, we are going to finish this webinar unless there are some questions. When to use? When you are bullish. The break-even price is the strike price minus the net credit received. So it would be this point here in the chart. The max loss is when the stock goes to zero. So let's say that you receive $1 and the stock and the strike price was $100. Well, the max loss is $99 per contract, which is a lot. And the max win is the credit received. What you want here is basically the opposite of the long put. You want the market to stay calm, stable, doesn't move much, stays there, don't big jumps on the price. Although if the stock price goes up, you are okay. And time decay is your friend. You want time to pass and constantly pass and pass and pass. So basically that means that you receive the money and you keep the money. Okay, so let's make just a short put market scan. We can scan the mega cap there. Let's say that we want percent. Let's use percentage again. Let's out of the money put. We always recommend out of the money put. Again, we are going to do a webinar about that. Let's use now return risk and let's see what we can find. Let's, yeah, there. So again, what we are doing is we are scanning all the market with the same filters that I have explained. And again, in less than 10 seconds, Tesla should be the stock that you should choose. And everyone knows this stock. So I don't know if there are some questions. This basically would be the end of the webinar. There are some books that I recommend. If you are just starting, you can use Trading Options for Dummies. I started with this book 3 years ago. This is an extremely good book. And these two books start to talk more about the Greeks and volatility. That is something that we are going to explain in a near future. As I have already explained volatility, we could keep talking about volatility, but we haven't gone much into details about Greeks, which Greeks are extremely important. You have delta, gamma, vega, rho as the most important ones, and level 3 is a new approach into the relationship of the Greeks, basically. So I would recommend this to read when you have, understood level 1 and at least one of these level 2 books. Please, you can join our Discord. You can follow us on Facebook, Instagram, Twitter, LinkedIn, and we will love your feedback. And you can contact me directly. Well, the education model, thanks Rodrigo for the question. The education model basically explains each one of the strategies. We can go here. You go to the education and you have one of each strategies explain that again, the strategy for the options are divided into 4 sections, and this depends into the market, into your market, like basically if the market is bearish, bullish, neutral with high volatility, neutral with low volatility. And we have a video and I have explained how to use break even, etc., for each one of these strategies. In 2 weeks, it's going to be a moment of high volatility based on earnings, and this is going to have a huge impact into stocks. So we are going to explain how basically we are going to focus more into neutral high volatility strategies and how to trade over big stock movements. So I don't know if you have any other questions. basically, thank you very much for your time. You can communicate with me in any time to my email. Well, thank you very much for your participation. I'm going to record this video and then I'm going to send it. So thanks a lot and have a beautiful day and a beautiful trading day. Bye.